This video examines the clinical appraisal of dissipative sports assets and introduces the Deficit Sustenance Valuation engine. Standard corporate accounting methods are often inadequate for this sector. This framework provides a defense against unbuffered speculation. Sports franchises function as quasi-firms driven by win maximization and regional prestige rather than traditional profit-maximizing goals. This structural default often leads to chronic operating deficits, further exacerbated by high player payroll inflation, which consumes most operating revenue. Clubs often act as conduits for wealth extraction by third parties. Intermediation fees, management fees, and survival debt origination costs all contribute to a forensic rule where a club's operational loss serves as the intermediary's yield. Traditional valuation models often fail when applied to sports assets. Whether it is DCF models requiring profits that don't exist or EBITDA multiples that distort reality, legacy methods often lead to mathematical irrelevance or fiduciary negligence. Risks in this sector include the impact of temporary capital influxes, known as the quote, sports washing trap, and the threat of non-compliance with financial regulations, which can trigger severe penalties and jeopardize the club's future. The Deficit Sustenance Valuation engine inverts standard logic. Value is calculated by aggregating hard physical assets and subtracting capitalized perpetual liabilities. Any investment above this defensible floor is categorized as a non-recoverable reputational expense. The mathematical architecture of this engine accounts for forced liquidation value, the operational drain of liabilities, and a bespoke discount factor that incorporates specific environmental and regulatory risks. The TILY model moves away from treating player registrations as static assets. Instead, it recognizes them as high-velocity mixes of options and liabilities, repricing them based on real market demand and the realities of forced liquidation. Capitalizing the operational drain is central to this method. We treat raw cash burn as a mandatory cost and address concentration risks found in standard owner-backed letters of support, using specific penalties to enforce due diligence. We discard standard market averages in favor of bespoke discounting. This includes quantifying environmental risks, assessing the specific probability of relegation, and applying numerical haircuts to account for regulatory noncompliance. Due diligence must align with different temporal horizons, ranging from the short-term distress cycle to the decade-long sovereign cycle, with a focus on verifying critical contract clauses that mitigate financial risk. In synthesis, the transaction price is often inflated by external metrics. The deficit sustenance valuation approach strips away these layers to reveal the hard floor, the only mathematically safe foundation for institutional capital. Ultimately, relying on legacy models in this ecosystem constitutes fiduciary negligence. Pricing must be based on liquidation value adjusted for liabilities, making this engine a critical instrument for institutional economic defense.